Okay, welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10:03 a.m. Pacific on Friday, July 18th, 2025, and we sit here. It's Tour de France is in full race mode. Got to give a shout out to the leaders there. Also, Open Championship weekend in that soggy Northern Irish weather. So, sports fans have some stuff to look at in these summer months. Hope you all are enjoying your summer. And let's jump into the bloodless verdict of the market, see how this week went. It was a pretty strong week for equity holders. Stocks were up 44 basis points looking at the S&P 500, putting the S&P at an all-time high close yesterday. Thursday, the S&P closed at 6,297 points, which was an all-time high. As we sit here recording this podcast, the S&P is at 6,287 points, so it's going to have a little rally if that all-time level is going to hold going into the weekend. The best performing sector, not surprisingly, is technology, up 1.75% this week. I mean, the good times keep on rolling in technology. Year to date, that sector's up over 12%. The lagger this week was the energy sector, down about 3.5%. And kind of if you want to drill down and look at equal weight indices, lag this week, down about 40 basis points. The S&P equal weight down about 40 basis points. So that just shows you the kind of top heavy nature of this rally. Even though we're at all-time highs, the real winners are the big tech companies, the big tech names. They just keep expanding into kind of world-eating size. And I don't know how long that can last. It could last another year, another 2 years, but at some point it doesn't seem like that's sustainable, and other parts of the market are going to have to catch up, or there's going to have to be a repricing. But as we sit here right now, it's all gravy in equity land. Moving on to the fixed income market, it was a positive week for fixed income. Fixed income investors in the U.S. aggregate made about 10 basis points this week. It's not much compared to those equities, but it's a smoother ride. Looking at the rate market, the 10-year Treasury is up a whopping 1 basis point on the week. The 30-year was up about 4 basis points because there was some consternation regarding Fed independence after the President of the United States floated in the media and amongst various congressional representatives the idea of canning the chair of the Federal Reserve, Jerome Powell, but fortunately that didn't come to pass and cooler heads prevailed, and now it seems like Jerome Powell's job is secure, but he's definitely going to be definitely having to be fielding questions at his next press conference regarding his job situation. And, the talk of the shadow Fed, which we've been highlighting for months here on Minutes, is definitely going to heat up. Looking into the best performing sector in fixed income this week was corporate credit, up about 20 basis points, followed by bank loans up about 18 basis points. But we had pretty good winners across the board there. The weakest sector was emerging market fixed income, down about 14 basis points. So positive week in the broad fixed income space. One other thing that's kind of interesting is that the curve has continued to steepen. Last Friday, the curve was about 52 basis points steep, looking at the 2s to 10s, and now it's about 55. So that steepening has continued to happen as, market participants and the market questions, the fiscal sustainability of the United States government, and looks at maybe that front end is going to have to come in a little bit if rates get pushed lower by the Federal Reserve or the next Fed chair, the next shadow Fed chair. I mean, it'll be interesting to see what happens there. There's been some whispers about there being dissents at the next board meeting as various Fed governors jockey for that next Fed chair job, which is up in 2026. So just something to keep an eye on. And rounding it out with commodities, commodities had a positive week. The broad commodity market was up over 1%. The the interesting point there is precious metals actually lost a little bit of their luster, down 35 basis points on the week, with the best performing sector being agriculture, up almost 3%. Crude oil was down a little over 1%. As we sit here, WTI crude is trading at about $67.50 per barrel. And gold dropped slightly on the week, currently trading at $3,359 a troy ounce. Dr. Copper up 8 basis points, so not much in the way of movement there. And finally, we'll finish it out. The dollar, interestingly, strengthened slightly, up 58 basis points on the weeks, currently trading at 98.42. And for all the crypto maniacs, crypto has consolidated this week. It hasn't really reached new highs. Currently trading at 117,521 per Bitcoin, US dollars per Bitcoin. I do find it interesting that there's this legislation regarding stable coins going through the Congress right now. And we were discussing that on the trading desk yesterday. Definitely that will be a topic of the week at some point regarding the implications for, the US Treasury market, the T-bill market. There's a lot of debate going on whether that's going to be bullish, bearish, what it means, but we will keep you guys apprised if that does pass, and we'll analyze it and have that as a topic of the week some point in the future. And with that said, that kind of wraps up the markets for the week, unless you have anything to chime in, Mr. Kimbrough.
No, I think that covered it. I mean, felt like a stable-ish week aside from that momentary 30-minute window with the Powell announcement and pullback or whatever that was. Let's jump into the economic data. It was inflation week, so we got a couple of things to cover here. We'll start off on Tuesday. We got CPI for the month of June. This printed at 0.3% month over month. That was right in line with estimates and 0.2% above the prior. We got the core number, the ex-food and energy. That came in at 0.2%. That was 0.1% below estimates and 0.1% above the prior. And we had the year over year came in at 2.7%. That was 0.1% above estimates and 0.3% above the prior. And lastly, you got the core ex-food and energy year over year. That came in at 2.9%. That is right in line with the prior and 0.1% above estimates. Little context for these numbers. This is actually the 5th consecutive month that core CPI has come in below the estimates. That streak was snapped for the headline number at 4 months because this month we printed in line. But just give a little context on the, inflation surprises to the downside we've seen so far in the last, call it 4 months. Looking under the hood here, we're going to be looking for tariff-related information here in the months to come. Let's take a look at core goods. That was up 20 bips on the month versus a prior contraction of 4 bips. Within this category, there's household furnishings and supplies. That was up about 1% month over month and contributed about 3 basis points to the headline print. That was almost fully offset by deflationary new and used car prices. Call it about 3% in the other direction, 0.3% in the other direction, 3 bips. But recreation commodities was another category that stood out in the core goods. That was up, call it 0.8% month over month, highest since October 2022. You can argue that a couple of these data points are signs of tariff impacts starting to show up. So far, the impact is minimal, but we're definitely on watch in the months to come. And also want to highlight just when it comes to this sort of data, look, we're looking to see the inflation come, but what matters more is how it impacts inflation expectations in the long run. So as long as those don't become unanchored, this can be seen as, kind of a, use the word transitory, one-off pass-through event, and we'll see how that goes. Nothing special on the core services side. We had shelter continuing to decelerate, medical services remaining elevated. There's 2 points I'll talk to. Kimmel mentioned this last weekend. We have 2 components, shelter and the super core. That's the core services less housing. Talking about those on trend, again, shelter continues to decelerate. Its 6-month annualized rate is now at 3.3%. That's the lowest since May of 2021. Super core, it's resumed its downtrend. All in all, we're having disinflationary core services and starting to contend with a pickup in core goods. Moving forward to Wednesday, we have PPI. This came through the headline at 0.0% flat. That was 20 bips below estimates, 0.3% below the prior. The ex-food and energy number also came in flat. That was 0.2% below estimates and 0.4% below the prior. This gets us the year-over-year numbers. You had 2.3%, again, 0.2% below the estimates, 0.4% below the prior, and the ex-food and energy came in at 2.6%. That was 0.1% below estimates and 0.6% below the prior. Again, you see most of these coming in, all of these coming in below estimates. That trend kind of seems to be continuing across the board for inflation data. Look, within this report, there's one component we've highlighted in the past. It's the final demand trade services. It's been a category people have been highlighting to watch for margin pressures. This month it came in at a negative 4 bips. It's negative 1 bip contribution, not really significant pressure. Contraction there would be a decrease in margins. It would reflect some of that margin pressure we're expecting to see. But all in all, goods, ex food and energy, it's been creeping up. It's at the highest level it's been since May of 2023. Like a little bit of goods inflation, services inflation looking tame within PPI. Not much to see here. At least it was positive, the stuff we did see. Also on Wednesday, we got a little manufacturing data. We got industrial production for the month of June. Not a lot in the manufacturing data this month, pretty flat. We got 0.3% relative to an estimate of 0.1. That surprise was primarily attributed to electricity generation. Again, not really much under the hood in this report, just basically a kind of a flattish manufacturing set of data here. Also on Wednesday, we got the Fed releasing the Beige Book. That's their 5th release this year. The last release was back in May. It was looking a little sour. April was, you can call that the most uncertain part of the year we've had so far. And this report showed, Dhall and I were talking about this a couple days ago. I think the term you used was incremental improvement seemed to be a way to describe this report. So that's I'll leave it at that for this. It just showed a little improvement since May. Brings us to Thursday. We get retail sales for the month of June. Strong report this month. Bit of a bounce for some of these components from last month. You have the headline number coming in at 0.6%. That was 0.5% above the estimates and a 1.5% boost above the prior. You have the ex auto and gas figure coming in at 0.6%. That's 0.3 above estimates and 0.6% above the prior. And you got the control group coming in, the one that hits GDP, at 0.5%. That is 0.2% above estimates and 0.3 above the prior. In general, this was just broad strength. 10 of the 13 categories in this report were up. The 3 categories that weren't, they had an aggregate contribution of 0%, 0.00. I mean, it was just gas stations, furniture, and electronics. I know gas stations is a somewhat of an important category, but furniture and electronics are pretty minor. And look, while these numbers did pick up, I want to highlight this over and over again with this sort of data. This is nominal data. In the event we see inflation pick up a bit, it could be a bit of a tailwind to this. We'll see how that works out, but just always want to remind this is nominal data. Thursday, we get another data point on our inflation front. The import price index for the month of June printed at 0.1%. That was 0.2% below the estimates and 0.5% above the prior. It brought the year over year to negative 0.2. It was unchanged from the prior. That was 0.6% below estimates. Again, not much to take from this data. This is continuing to support the disinflationary trend of our inflation data.
One thing that I'll kind of add there, though, is
Please.
kind of there's a feed through there into the PCE. So it looks like that the PCE isn't going to be a hot print this month based on the information that flows through to it that's already dropped. I mean, naturally there could be a surprise, but it's just maybe incrementally dovish on the inflation front.
Yeah, I looked at Cleveland Fed this morning. We had 0.24% as the estimate for headline PCE and 0.21 for core. So I would bring the year over year to call it just under 2.7 for core. So still tame-ish, but yeah, agreed. It's not much to be seen here. At least nothing scary yet, but we're still on the outlook to see what happens in the months to come. Getting down the wrap up here, we got Thursday initial jobless claims, the week ending July 12th. That came out at 221K. 12K below estimates, 7K below the prior. Actually, we've been getting a little relief in this data. The 4-week moving average has been on the decline for 4 consecutive weeks. That relief we're not seeing, though, in the continuing claims report. That came in for the week ending July 5th at 1.956 million, just barely below estimates and a little above the prior. But this has seen the continuing claims rise on the 4-week moving average for 7 consecutive weeks. It's reflecting the difficulty in, even if initial jobless claims calm down, the difficulty in those people finding new jobs is still there. And that brings us to Friday. Today we had University of Michigan sentiment inflation data. The headline printed at 61.8. That's 0.3 above estimates, 1.1 above the prior. I'm going to say in general, sentiment still is pretty rough. I mean, the current conditions metric, it's on the high of the year, better than we looked last year, but expectations are still pretty rough. What we do care about more, though, in this is the inflation expectations. Powell's spoken to them in the past. They've appeared a little sensational this year. Some of these numbers are a little high, but this month, they surprised to the downside and are coming back down nicely. The 1 year number printed at 4.4%. That's 0.6% below the estimate, 0.6% below the prior, while the 5 to 10 year number came in at 3.6%. That's 0.3% below estimates, 0.4% below the prior. Again, more data surprising to the downside. It's nice to see this at least directionally moving in the right direction, even if the absolute numbers still appear elevated. They still do reflect, risks with the people who were surveyed for this particular report, but move in the right direction. And that wraps up the week.
Yeah, definitely eco-packed week in the markets, along with some headline grabbers regarding the Federal Reserve. Nice synopsis, Mr. Kimbrough. I think that the main takeaways there is the U.S. economy is humming along. The inflation boogeyman has not shown its face, and consumers are still spending. So definitely, America is showing resilience thus far. We will see how things evolve over time, and we'll keep our listeners updated. Kind of shifting gears onto the kind of interest rate front. Looking out right now, it looks like the July 30th meeting that's going to occur in 12 days is a nothing burger. I mean, the market basically thinks nothing is going to happen. The most interesting thing that's going to happen is probably the press conference and looking at to see how many dissents there are regarding the interest rate policy. So the market still thinks that there's a over 50% chance of a cut in September, but by year end, the market's only pricing in maybe 2 cuts. So we'll just have to wait and see what happens and keep you guys apprised as new information flows out. But that's kind of the state of the affairs of the Fed. Naturally, the talk is going to be really about who's going to be the next Fed chair, and that debate's going to rage and continue.
In the
Next
months to
week,
come, we definitely have that queued up. It's going to be entertaining.
yeah, definitely going to be interesting to keep an eye on. The things to keep an eye on next week regarding economics are pretty light, but we'll get into it. It's the LEI, the broken clock indicator. I don't know if that thing's worth much anymore, but it's going to come out on Monday. We'll see what happens. Thursday, we get initial jobless claims and continuing claims. The estimate is for initial jobless claims to be a little higher, but we'll see what happens there. We also get the S&P Global US Manufacturing PMI. It's the July preliminary number. And we get the U.S. Services PMI, the July preliminary number. So those could be interesting. They're forecasted to be, the industrial numbers forecasted to be a little down, and the services number is forecasted to be a little up, but we'll see what happens and keep you guys apprised. And then Friday, we get durable goods orders and cap goods orders, and that kind of wraps up the week next week. So a light week for next week, and we hope all you listeners enjoyed this episode of DoubleLine Minutes.
You know what? One last thing to highlight, actually. We got Sherman's mid-year outlook posted on YouTube, and he's joining the Bloomberg ETF IQ on Monday at 9:20 a.m. Pacific time. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Thanks for tuning in, and I hope everyone enjoys this summer weekend.